First, we start off with stocks going wild. That is right. Everything is awesome again. The Dow surging nearly 550 points as stocks snapped back from last week's sell-off after a number of strong earnings reports. All 11 S&P 500 sectors were in the green, led by tech, healthcare, both up 3%. Stocks closing right near the session highs. So, is the worst over for the market? Is the bull run back on track, Guy?
Before I answer that, is that a computer-generated? Is that an actual person singing that?
Come on,
these are real people singing a real
Lego
song,
movie,
Guy.
buddy.
That Chrissy Teigen's sister?
Yeah, Chrissy Teigen, whatever.
Fantastic. We just listened to it. It's fantastic.
Can you
just
speak
amazing.
at the same time?
Look, if you'd said to me, Gee Swizzle, tomorrow the market's going to move 500 points. You could say, Gee, the market's going to move 500 points tomorrow. Which way? Given yesterday's close, I would have said categorically 500 points lower, and here we are 550 points higher, which goes to prove day to day there's no way to figure this out. For the bulls, they will say we stopped dead at the 200-day moving average in the S&P. The bull market is still intact. I'm still more skeptical. You heard Morgan Stanley last night. I still think there's downside, but you can't argue with the fact that this market did everything it needed to do technically on the downside, held, and is now bouncing.
What do you think?
I think it made a series, as we talked about yesterday, real quick, series of higher lows. That was bullish for the market. Netflix, the best indicator of where we're going into year end. Momentum versus value. I'm on the side of momentum. I'd stay there.
Is this all a technically driven market? I mean, all the things that we were explaining away, the downside to last week, most of those things are still intact.
Yeah,
the Fed worries intact. I mean, rates have abated a little bit, but still.
There is zero in the form of, I think, a bright light in terms of the China trade tariffs. I think rates are probably range bound to higher. The Fed, if anything, borders on being a little bit more hawkish here. Look, we had some good news in Europe. The Italians seem to have balanced their budget, or at least given you something on a range of debt to GDP that makes the European Union happy. I think there are the same factors that are at large here. It's nice to actually have earnings take center stage because, frankly, companies are doing very well. But I think the valuation dynamics, a market where the multiple should continue, I think, to compress in this environment, weighs over the market.
Karen?
I always like to look at the earnings. I mean, to me, we get in these pockets where there's no earnings. And so we were there for, I don't know, until last Friday. And to me, the earnings have been really, really good. Today we'll talk about a number of them, really good. And the guidance has been much better, it feels, this week than last week. So I don't know, is the worst over? Maybe. I think, in the short term, yes. I think that the market at this multiple with these earnings is good to own.
Well, okay, all the worries that we talked about, tariffs, trade, et cetera, the Fed, they all exist. So with earnings coming in better than we expect, or at least in line, does that set up for that seasonal lift higher?
It's encouraging, without question. Karen's right. I mean, it does come down to earnings, but I still think the headwinds that we talk about all the time, they didn't go away. They didn't magically go away today. We're no closer to a deal with China. We're no closer to the rate story being somehow fixed. I mean, I think of anything, you saw the JOLTS number today, which is probably the reason why the market was up 500 points, just gives the Fed some credibility to continue to move forward, which is a reason why we were selling off to a lot of people's book in the first place. So although earnings have been good, markets don't necessarily sell off because earnings are,
But you had
it's never an earnings story necessarily that's going
to speak to the seasonality of it. You had hedge funds on average down 3% going into October. The first week on average, in the first week of October, they lost over 4%.
So what does that
There
mean
has to be a chase for performance going into year end.
So they're just going to be indiscriminately buying, putting money to work.
Not indiscriminately, but you have to go to
higher.
wherever you think you're going to get the bounce. And with Netflix report today, I would say that they probably chase those names.
But bounce is the operative word. I just think this comes down to positioning. And where we were going into this sell-off was that you had complacency at level highs. We hadn't really been back to this level of positioning since January. And then we went to extreme oversold. And we talked about that 9-day RSI at 9.7. That was the lowest we'd seen on the S&P since 2001. So how oversold were we? Dramatically. At a time when you can't necessarily see the China trade rolling into the numbers. We're not going to see the impact of China trade in the numbers probably until, I would think, December at best. And therefore, I think a lot of this has just been a mirage for people. But to me, it's all about positioning and sentiment. I don't think the sky is falling. I just think that the market is fairly valued at a time when everything we just said earlier in the show, or a guy talked about, we all talk about it. To come on tonight when the market is up 500 points or 2% on the S&P and feel like it's gone away would be disingenuous.
Okay, so let me ask you this. Do you sell into this rally? I mean, are we that, are we questioning this rally to the point where you say, you know what, maybe use this bounce to take some profits?
Well, I've seen this act before without question. We talked about this last week, the fact that, every time it seems like it's over its skis and about to collapse, something happens and bails it out. And this is a movie we've seen over and over again. So can this last a couple more days? Absolutely. But I will still say, I think in terms of the headwinds that the market was scared about a week ago, they haven't gone away.
The headwinds have not gone away, but just think about the tailwinds that are coming back. So we had the buyback blackout. Now we have earnings. We're going to get the buybacks back. And you could argue that it's 20 to 30% of the tailwind in the overall market as far as buybacks. So you're going to have multiple tailwinds going into year end.
Yeah. I just think that maybe we're all saying this, but if I look at the DAX, if I look at the MSCI-EM, so the EEM, they're all basically trading. You've got as 2 or 3% up to a trend line that's been straight down since effectively January. And until you break out of that range, that's where you are. So you can chase for 1 or 2%, but your market call here tells me that I don't think you have a lot to do here in terms of chasing it significantly higher.
So what trades do you stick with going into the end of the year? I mean, if we are to use this guide, I mean, did you see the Bank of America Merrill Lynch Fund Manager Survey? A record high number of managers were skeptical of growth, right, since 2007. The most crowded trade, long FANG and BAT stocks, short treasuries. So the same playbook that most people have been in the whole year, right up through October. Is that the ticket you want to use?
Well, to me, the place that I feel most comfortable are in names that have multiples that are defendable here. And I would go also to the energy sector and even the commodity sector. I mean, if we've got inflation, we're seeing asset price inflation. And a lot of these energy companies are delivering free cash flow, have free cash flow yields, integrated names like Chevron and Royal Dutch Shell that we haven't seen in these companies in a couple decades. So this, to me, is a safe place to play at a time I don't think energy's fallen off the table.
The move to value. You like growth, though.
So I do like growth, but if you have a growth get hit by 30 or 40% or 20%, I think those are the names where you could make that up in a matter of months.